Hello everyone. The purpose of this video is to practice analyzing transactions using the expanded accounting equation. So in our module 1, when you go to this page, Analyzing Transactions Practice, you'll see a transaction analysis of common transactions using the basic accounting equation. We're going to analyze these transactions using the expanded accounting equation. So the expanded accounting equation shows the components of equity, which are highlighted in red here, and the effects of those components on total equity. Common stock is an investment of stockholders by buying stock. It increases equity. Dividends is a distribution of cash or other assets to the stockholders. It decreases equity. Revenues are earnings from the business that result from delivering goods or services to customers. Revenues increase equity. And expenses, the cost of selling goods or services, decreases equity. Now this expanded accounting equation expands equity into its components. Now equity can be firstly expanded into two main components. Contributed capital. Contributed capital is the amount contributed to the corporation by its stockholders. And then the remaining three components of equity can be classified under the umbrella term retained earnings. Now let's break down what that means. Retained earnings is the profit earned by the business that is not distributed to shareholders. Let's break that down even further. Profit. Profit is the net income when revenues for the period are greater than the expenses. And dividends are distributions of profit. So retained earnings is revenues minus expenses minus dividends. Look closely at the transactions that affect one of these four components of equity and analyze them further. Remember that transaction analysis consists of three steps. We identify the accounts and their account types that are affected in the transaction. We decide if the accounts increase or decrease, and we determine if the accounting equation is still in balance. So let's look at transaction number 4, where the business pays in cash rent for office. Rent expense is an account that is an equity account. Expenses decrease equity. And this transaction also decreased cash. Transaction number 5, the business performs a consulting service for a client and is paid in cash at the time of service. Revenues are an equity account that increases equity. So revenues are increased, equity is increased, assets are also increased. Transaction number 6, the business performs a consulting service for a client. The client will pay when he's billed. Again, revenues increase equity, and this transaction also increased assets. Transaction number 7, the business incurs utility expense when the PG&E bill arrives. The business will pay later on the due date of the bill. Well, the business has incurred an expense. Expense decreases equity. and a liability is increased because we will record that as an accounts payable, a liability. And finally, let's look at transaction number 8. The business pays in cash dividends to its stockholder. Dividends decrease equity. And on the other side of the equation, assets are also decreased. In our transaction analysis using the basic accounting equation, we see that the total equity at the end of the period is $8,900. Now we've broken down that equity into its various components. Common stock, which increases equity, $6,000. Dividends, which decreases equity, $1,200. Revenues, which increase equity, $5,800. And expenses, which decrease equity, $1,700. Added together, they equal the same total, $8,900 in equity.